So what's up, guys? So it's Sunny here today again. So people ask me that if I want to invest in real estate, what's the first thing you should do? Or if I want to buy a house, what should I be doing? First thing I would tell them to get pre-approved from at least one or two mortgage broker. So today we'll be talking about the type of mortgages that the mortgage broker could provide, and what you need to give them, what kind of documentation you need to give them, and how to get the best rate on your mortgage. Well, I know you guys enjoying those videos, but it would be very helpful if you can give me a like. It doesn't even take you that long. And subscribe if you want more content. Nice, thanks. So first of all, this is a very traditional. There's about three traditional mortgages. There's a big category. So one will be FHA, first time home buyer mortgage. So the second one is conventional, and the third one would be the VA. So let's talk about first time home buyer. First time home buyer, I think this is the most advantage to the people that trying to get into trying to get a house, and they only need to put in 3.5%, and they need to qualify for the mortgage. Obviously, you need to live there for at least a year, and you have to consider that you need to prepare about 2% of closing costs for the loans. But I feel like this is the best way to get into real estate, just to put 3.5% down, which is about, if your house is about $200,000, it's only $7,000. And you should be able to, if you take a few years, you should be able to save $7,000, maybe a little more for the closing costs and reserve and all that. So if you live in a housing market that costs you about $200,000, this is the very easy loans to get approved for. I think one disadvantage about this one is that there's a lot of inspection that come along with the first time home buyers. That's why some of the seller, when they say, oh, this first time home buyer, they don't like that. And it's more you can't really buy this one with the fixer upper. For the conventional loan, that's the second type of loan that we were talking about, is conventional mortgage. So conventional mortgage, this one, you can do it as a primary resident, which you'll get a better rate, which means that you have to live there for a year. And you can also use this loan as a second home, or primary for investment only, or vacation rental. But if you don't actually live there, your rate will go up maybe like by 1-2%. So the down payment for this one, it depends on which broker you talk to. Some of them have a pretty good low down payment, like 5%. So it goes from like 5% to 25%. It depends on what kind of products they have. That's why you have to talk to more than one broker, so you kind of understand, because not all broker has the same product, because they're working with companies, they're working with actual like other the company that provide mortgages. So it depends which one they work with. So if you want this one, it's better for people if they're planning to buy a fixer upper and they're planning to live there for a year, and maybe like fix it up to build equity that way. I think this is a pretty good loan if you want to buy a fixer upper with it. There's the house is not livable. This is a little more advanced. This is like a hard money lender. You can get a loan with them also, or you can call like a bridge loan, but that's a little more advanced. It's non-traditional loan that you can get. They'll look at more of the deal instead of how much you'll be qualified for it. But that's only when you have the property is not livable. But you could also, but if the property is livable, it just needs some upgrade, remodel, you could definitely use the conventional loans. But normally they require you to have, carbon monoxide, and if you live in California, like double strap your water heater. And obviously you have to save 1 to 2% for closing costs also. For a third loan that we'll be talking about is that it's the VA loan. It's this is one is for veterans or active members only. So this is a special loan that's secured by the VA. And it's a why is it so special, you ask? It's a 0% down. That's why it's so special, because it's secure by the VA. That's why they're able to do 0% down. This is how they give back to the veterans and active military members. But there's also a funding fee, and there are also the closing costs that you need to pocket out. And obviously you need to qualify for the loan. Even though it's a 0% down, doesn't mean that you're gonna be qualifying for it. And sometimes there's also like a maximum of how much you can get, and you can actually use this loan for more than one time if you but they require you to live in the property within. You can't really buy this one as a investment, so you have to actually live in the house to be able to get the VA loans. And yeah, I think it's the best option if you're veterans or military members to be able to qualify for it. However, there's a downside to the VA loan because it's VA. They need to make sure that the property is livable, and there's very similar to FHA. There's gonna be more inspection. If you don't have pass inspection, there's gonna be more. They're gonna require the seller to repair this and repair that. And sometimes the seller doesn't want to work with the VA because they require them to fix a lot of stuff up. And same thing with FHA. If it's like a seller market, and it's gonna they would rather go with the conventional, it's easier to work with and there's not a lot of stuff that need to fix. But obviously if it's move-in ready, there's nothing for them to lose. So I think this loan is pretty good for something that's already been remodeled, and you don't need a lot of fix up, or it could be like a new build. And when you go talk to a mortgage broker to get pre-qualification, or pre-approved, they'll ask you for a list of documentation. Let me see here. So normally what they ask for is 2 years of tax return, 3 months of pay stuff, 3 months of bank statements, and they will ask for a 1099 if you're like a contractor. You don't have the W-2, or you don't have like a regular 9 to 5 jobs. And also they'll need to know what kind of loans you have, auto loans, student loans, and personal loans. And also they need your employment history for at least 2 years. So that's the general ways that there's general stuff that they'll ask for you. That's what they have. And also if you have properties, there's more stuff that they'll, like for me, okay, I have a property, so I have to have mortgage statement. I need to have sometimes they ask for the lease, they also ask for mortgage declaration, and they ask for the insurance. So you have the property, it's more complicated. They will ask for more documentation. But that's I think that this might not apply to most of the people. So if you ask how to get the first or the best rate possible for the mortgage, so to get the best possible rate, you have to compare it with 3 other brokers. Normally you need to compare what type of products they have. Sometimes they have 5% down conventional loan. Sometimes they don't. They only have 25% down conventional loans. So you need to talk to at least, I would suggest at least 3 mortgage brokers to, be familiar with the loans and ask them questions and see if you can get them to, beat the other person's rate. That's how you get a better deals on the mortgage. And so you have to compare when they tell you. Sometimes they give you a better rate, but sometimes their closing cost is more. So you need to look into that too. So with all the fees and stuff, you need to look at all that stuff. You can ask for like a printout of the loans disclosure, so they can do a loan disclosure, and it's like, oh, okay, this is how much you'll be paying about, and they'll list all the stuff that you'll be paying, and you can compare all that with, but you have to compare the rate first, and then you look into more detailed stuff. That's how you can be able to get better rate. So if this video helped you in any way, just give me a like and subscribe. I'll see you next time.